The intricacies of behavioral finance, exploring psychological influences on market choices. Welcome to our channel, where we unravel the fascinating interplay between human psychology and financial decisions in the captivating realm of behavioral finance. Behavioral finance is a multifaceted field of study that delves deep into the psychological and emotional factors that influence investment decisions and, consequently, market outcomes. It recognizes that traditional finance theories, which assume that all market participants are rational and make decisions solely based on maximizing their utility, do not fully capture the complexities of real-world financial markets. Instead, behavioral finance seeks to understand how cognitive biases, emotions, and social influences impact the choices investors make and the resulting market dynamics. To comprehensively explore the realm of behavioral finance, we must delve into various aspects, theories, and key concepts that define this discipline. Before we begin, make sure to smash that like button and hit the subscribe for more exciting content. 1. Cognitive biases. One of the central pillars of behavioral finance is the recognition of cognitive biases that affect decision-making. These biases include confirmation bias, overconfidence, anchoring, and loss aversion, among others. For example, confirmation bias leads investors to seek information that confirms their pre-existing beliefs, while overconfidence can cause them to underestimate risks and overestimate their abilities. 2. Prospect theory. Developed by Daniel Kahneman and Amos Tversky, prospect theory challenges the traditional utility theory by proposing that individuals do not make decisions based on absolute gains and losses, but rather on perceived changes from a reference point. This theory helps explain why people often make irrational choices when faced with potential gains or losses. 3. Herding behavior. Humans are social creatures, and this social aspect plays a significant role in financial markets. Herding behavior, where investors follow the crowd rather than conducting independent analysis, can lead to market bubbles and crashes. The dot-com bubble of the late 1990s and the housing market crash of 2008 are prime examples. 4. Emotional influences. Emotions like fear and greed can have a profound impact on investment decisions. Fear can lead to panic selling during market downturns, while greed can drive speculative bubbles. Understanding the emotional roller coaster of investing is vital for grasping market dynamics. 5. Market anomalies. Behavioral finance identifies various market anomalies that challenge the efficient market hypothesis, EMH. These anomalies, such as the value and momentum effects, suggest that markets are not always efficient and that certain strategies can consistently outperform. 6. Behavioral biases in investment management. Behavioral biases in investment management delve into the subconscious tendencies that influence decision-making among professional fund managers. Despite their expertise, these managers are susceptible to cognitive biases such as overconfidence, herding behavior, and loss aversion. These biases can lead to suboptimal portfolio allocation, misjudgment of risk, and missed opportunities. By recognizing and addressing these biases, investment professionals can enhance their decision-making processes and potentially yield better outcomes for their clients. Understanding how behavioral biases affect the management of investment portfolios is crucial for improving overall performance and aligning strategies with rational decision-making principles. 7. Prospectus disclosure and framing effects. Prospectus disclosure and framing effects shed light on how the presentation of information influences investor decisions. The framing of information, whether emphasizing potential gains or losses, impacts investor perceptions and choices. Prospectus disclosure, a legal requirement for investment information, highlights how the structure and wording of these documents can shape investor expectations. By understanding framing effects, financial institutions can design communications that guide investors toward well-informed decisions. Acknowledging the psychological nuances in how information is presented empowers investors to make choices aligned with their goals and risk tolerance, fostering transparency and trust in the financial industry. 8. Adaptive market hypothesis. The adaptive market hypothesis introduces a dynamic perspective on financial markets, acknowledging the interplay between investor behavior and evolving market conditions. Unlike traditional models, which assume static market efficiency, this hypothesis proposes that participants adapt their strategies based on experience and changing circumstances. It amalgamates insights from behavioral finance and classical finance, offering a nuanced understanding of market dynamics. The adaptive market hypothesis contributes to explaining market anomalies and the varying efficiency levels observed in different market environments. By recognizing the adaptive nature of markets, investors can better navigate the complexities of real-world financial landscapes, enhancing their decision-making processes and overall outcomes. 9. Investor behavior during crisis. Investor behavior during crises unravels the psychological underpinnings that drive market reactions in times of uncertainty. During crisis, fear, panic, and herd behavior often lead to irrational decision-making, exacerbating market volatility. Behavioral biases, such as loss aversion and recency bias, play a significant role, causing investors to overlook historical context and react emotionally to short-term events. Understanding these behaviors enables policymakers and market participants to design interventions that mitigate extreme market swings. By addressing these behavioral tendencies, investors can make more informed choices, while regulators can implement measures to stabilize markets and safeguard against systemic risks, fostering resilience during turbulent times. 10. Behavioral economics versus traditional economics. Behavioral finance is closely related to behavioral economics, which applies psychological insights to the broader field of economics. These disciplines challenge the classical economic assumption of rationality and highlight the importance of understanding human behavior for accurate economic modeling. In conclusion, behavioral finance is a rich and evolving field that examines the intricate interplay between psychology, emotions, and financial decision-making. It sheds light on why markets are not always efficient and why investors often deviate from rationality. By recognizing and understanding these factors, investors, policymakers, and financial professionals can make more informed decisions and work towards more stable and efficient financial markets. The study of behavioral finance is a continual journey into the depths of the human psyche and its impact on the world of finance. If our videos prove valuable to you, be sure to express your support by sharing, subscribing, and giving the like button a solid click to help our channel grow.